Hello there, this is Hector. Welcome to my Forex trading course. Over the following chapters and the following videos, I'm going to be explaining in detail my trading system, okay? All the different tools and trading strategies I use in order to, trade for a living full time, and how you can also absorb and adapt those techniques, those strategies into your own trading. Okay, I don't want to get ahead of myself. In this first chapter, I only going to be talking about how to spot valid trading opportunities, how to seize those opportunities, and filter out the high probability trades, the high probability setups, and discard all the rest. Okay, in this first video, I'm going to be laying out in detail how I personally spot trending scenarios. Okay, how I spot the trend, how I qualify the trend. You know, different traders use different techniques. Some of them use the ADX indicator. Some others use actual trend lines. I myself prefer to rely on actual moving averages. And the reason as of why I prefer moving averages over trend lines is because trend lines usually leave too many loose ends. For example, in this chart you are seeing right now on my live screen, which as you can see is the American dollar against the Canadian dollar on the 4 hours time frame. You can always draw a number of trend lines in your chart. Clearly the trend starts here, and we can firstly draw that trend line, that first trend line. As we can see, it gets breached there and then there, so therefore we can draw yet a new trend line, which it holds in place there, and then it's retested and holds once again there, but then it gets breached there. Okay, so you may be thinking, all right, this trend is finished, now we are heading up. But as you can see, we are actually afterwards, price continues to go down. Therefore, we can draw yet another third trend line, okay, right there, which once again, it holds price there, and finally there, but then it gets breached there once again, and it seems like it's turning around yet again. So that's my problem with trend lines. There are too many loose ends, too many possible readings on that trend, and I usually find moving averages to be more reliable, okay, more stable as per where the trend is going. Okay, I use three moving averages as far as spotting the trend. That's the 30 simple moving average of the close, the 50 simple moving average of the close, and the 100 simple moving average of the close. Okay, I usually plot the 30 in green, then the 50 in red, and the 100 in blue. Okay. Now, once I have those three moving averages plotted on my chart, I search for 6 particular conditions to apply, okay, to be in place, all of them at the same time, before I can safely label a trend as, let's say, healthy or stable. Okay, now I'm gonna be listing all those 6 conditions to you, and I'm gonna be explaining the logic behind. Okay. Alright, the first condition is that all the 3 simple moving averages are in order. Okay, as you can see, in this case we have the 30 moving average below the 50 and the 50 below the 100. Okay, that means that the first condition is fulfilled, and therefore we are possibly, if all the other conditions apply, we are possibly looking into a solid downtrend. Okay. Moreover, the second condition is that all the moving averages are pointing in the same direction. Okay. As we can see, all the different moving averages, the 30, the 50, and the 100, they are all pointing down in the same direction. Okay, we don't have, we could have the 30, the 50, and the 100 all in order, but the 30 already curling up and beginning to point up. Okay, that would mean that this trend is weakening, is endangered, or at least for the time being, is not as strong as I would like it to be, okay, in order to search for trading opportunities. All the way along on this USD against the Canadian dollar 4 hours chart, we can see that all along the moving averages have been in order and always pointing in the same direction, okay, so those two conditions are certainly in place. The third condition is that all the three moving averages are parallel to each other, or if you prefer, that there are no crossovers, okay. And once again, as we can see, well, there are no crossover whatsoever in the screen, all right? On those moving averages, they are all of them parallel to each other, or like I say, no crossover whatsoever. Always the 30 moving average remains below the 50, and the 50 always below the 100. Always parallel to each other, always pointing in the same direction, and no crossover whatsoever. So far, so good. We are certainly, for the time being, we are certainly downtrending. Now, the fourth condition is that price remains on the right side of the 50 simple moving average most of the time, okay? Remember that the 50 simple moving average is the one in red, and what I like to see is price on the right side of the 50. That means that if we are looking into a downtrend, I like price to remain below the 50 simple moving average most of the time, okay, and it's been so. I mean, it's been below the 50 for quite a while. A little pierce above is okay, as long as it dives back down immediately. At the end of the day, the markets are not perfect, okay. The markets, you cannot expect price to behave the way we like it to behave all the time. So in a trend, sometimes on a pullback, okay, we might see price breaching above the 50 for just 1-2 bars, and immediately after diving back down. Like I say, as long as that breach above doesn't take more than 1-2-3 bars maximum, within 1-2 or 3 bars, price dives back down into the right side of the 50 simple moving average, we can safely say that the trend is still in place, all right. Basically what we want is the 50 simple moving average holding price on the right end of the trend, meaning below, in this case, since we are in a downtrend, below the 50. Now, the fifth condition is that the 100 simple moving average has never been breached, okay? In my opinion, this is an important condition. I want the 100 moving average to never been touched, okay, never been violated, and price being nowhere near it, in fact, okay. Just as I said that as I said before, then it's okay to have a quick touch above the 50, as long as price dives back down immediately after. I like price to be nowhere near the 100, okay. Any single touch, even if it's just for 1 bar, I consider the trend to be jeopardized. And the reason for that is that, well, we all know that as price trends in one direction, we go through two different stages, okay. One is the thrust, the swing in the direction of the trend, and then we usually see a little bit of a pullback, then another thrust, then another pullback, another thrust, pullback, okay. Most of the trends are shaped up in that way, okay. A swing in the direction of the trend, a little bit of a pullback, which is never as long as the previous swing in the direction of the moving averages. Then after the pullback, once the pullback has been finished, we take off yet in another swing in the direction of the moving averages, then yet another pullback, which is never quite as long as the actual previous swing, okay, never quite as long, and then another swing, etc., etc. Well, in this trend, as I was just showing you guys, well, we basically go through swing, pullback, swing, pullback, swing, pullbacks, and so on. In order to, in most of the trends, in order for price to touch the 100, usually what we see is is quite a large pullback. Okay, let's assume, for example, this last swing I'm marking right now in my screen, and it's followed by this pullback. If we were to reach the 100 simple moving average, that means that the pullback would have been, in most of the cases, quite as long or almost as long as the previous thrust, as the previous swing in the direction of the trend. Okay, and that's not a healthy indication. Okay, that's never good to say. You always want the impulse part of the swing to be much larger than the retracement part. Okay, you have a nice long thrust in the direction of the trend, and yeah, small pullbacks are all right. If we were to reach the 100, as you can see, the pullback would have been way too deep. Okay, the pullback would take quite a long bite, quite a deep bite into the trend, and that usually is a signal, an early indication that the trend is actually weakening down. Okay, so that's why the fifth condition of my system, as far as spotting trends, healthy trends, I mean, is that the price is never gets never around the 100 moving averages. Okay, so far we have all of them pointing the same direction, all of them parallel, no crossover, all the moving averages in order, price remaining on the right side of the 50, and nowhere, even if it's just for 1 second, we might breach a little bit above the 50, but never to the point to get around the in the nearabouts of the 100. Okay. And finally, the last condition, the sixth condition, is that price swings harmonically off the area between the 30 and the 50 simple moving average. All right, that's what I call myself the dynamic area of support and resistance. Well, in this case, resistance, since we are in the downtrend. Okay, I usually mark the area between the 30 and the 50 simple moving average as a dynamic area of resistance. I like all the swings to take off around from this area. Okay, I like the for example, price retraces back to this area. This dynamic area of resistance holds the price below, and from there a whole new swing takes off in the direction of the trend. Okay, then sure, we may have another pullback, but I like to see once again the moving averages, the 30 and the 50 simple moving average, or rather the area in between, the dynamic area of resistance, to hold the price below, to indeed work as resistance, and from there price to take yet another swing in the direction of the trend. Okay, then another pullback, price reaches the dynamic area of resistance, and bang, another swing in the direction of the trend. Okay, and so on and so forth. Once price in fact, breaks above the dynamic area of resistance, once the dynamic area of resistance actually does not work as resistance or stops working as resistance, price breaches above the 50 simple moving average and gets near the 100. That's an early signal of weakness. Okay, I'm gonna be showing you now some examples, clear examples as of why I consider the area between the 30 and the 50 to be a dynamic area of resistance. But just to dip you guys into this concept, I like price, all the different swings, okay, all the different retracements to end at this precise junction of the chart, and moreover, most of the different swings to be created of that area. All right. Now, I'd like to stress the point that these 6 conditions are universal across across any time frame and across any currency pair. Okay, when these 6 conditions apply, you can rest assured you are looking into a healthy trending scenario, no matter whether you are an intraday trader, a long-term trader, whether you like to trade the euro, whether you like to trade exotic crosses, like I say, it's a universal principle, okay? Now I'm going to be showing you different examples of different currency pairs on different time frames, and you will see how these principles, all these conditions apply equally to all of them, okay? And once they apply, we are indeed looking into a clearly trending scenario, right? Firstly, let's assume you are an intraday trader. You mostly you like to follow for possible trading opportunities of the hourly time frame or the 30 minutes time frame, okay? Let me show you another chart. That's the USD against the CHF, the Swiss franc on the 30 minutes time frame. Okay, it's one of the favorite time frames for intraday traders. Okay, as you can see, the moving averages are also fulfilling the 6 conditions I was mentioning before. They are all in order. They are all pointing in the same direction, meaning down. All of them remain more or less parallel to each other, okay? There is basically no crossover between the moving averages. Moreover, price is spending most of the time on the right side of the 50 simple moving average. We have a quick breach above, but like I say, within 1-2 bars, price immediately dives back down, okay? Price has never been anywhere near the 100, okay? This is the 100 moving average, the one in blue, and as you can see, price has never been anywhere close around them, and well, it's never been touched, the 100 I mean, and moreover, price is swinging harmonically off the dynamic area of resistance, okay? Resistance in this case is we're in a downtrend. So, as you can see, we have a swing down, retracement, the moving averages catch up with price, they do indeed work as resistance, and they push price down yet into another swing. Then we have another retracement back up, the dynamic area once again holds the retracement, bang, another swing to the downside, okay? And therefore I can, as far as my system goes, I can safely label this currency pair on this particular time frame as a perfect trending scenario, okay? This is a solid, a healthy downtrend, and therefore this is in a scenario I like to search for short opportunities. All right, I don't want to get into how I go about finding my entry signals, my money management rules, my profit takens, my stop loss placement, etc, etc, etc. I will lay out all that in detail in future chapters. For the time being, I just want you guys to remember that once those 6 conditions apply, once the dynamic area of support and resistance is indeed holding price on the right side of the trend, short opportunities in this case, since we're in a downtrend, are high probability trades. Now let's assume you are in scalper. You like to trade the very short time frames, such as the 5-minute chart, the 15-minute chart, and well, you always trade from an intraday perspective, but moreover, quick positions in and out real quickly within 5-10 minutes in order to squeeze 10-20 pips out of a move, okay? Now let me show you a 5-minute chart. In this case is the euro against the Japanese yen. Okay, like I said, on the 5-minute time frame, and well, we can clearly see how the moving averages are plotting as I like them to be, all of them pointing in the same direction, all of them in order, the 30 above the 50 and the 50 above the 100. They are all parallel to each other. There has not been any crossover for quite a while. As you can see, the 30 has always been above the 50 and the 50 always above the 100. Price nowhere near the 100, which is the one in blue, nowhere near the 100 for quite a while as well. price spending most of the time, in fact, well, all the time really, above the 50, price harmonically swinging of the dynamic area of support in this case, since we're in an uptrend. So basically what we see is the dynamic area holding price above, and as long as it does so in this uptrend, we are long opportunities, okay, long setups are high probability trades, and therefore we want to be searching only for long entries, okay. It doesn't matter, like I say, whether you're a scalper, an intraday trader, or perhaps a long-term trader. Let me now show you a daily chart. In this case is the euro against the GBP, the sterling pound, on the daily time frame, okay, long-term perspective. The chart goes back about half a year, even 7 months actually, and as we can see, the moving averages pointing up, okay, all of them in order, price nowhere near the 100, the price harmonically swinging of the dynamic area of support in this case, since we are in an uptrend. So you see, this is the area between the 30 and the 50s. You can see it's holding indeed as it's working as a dynamic area indeed of support, okay. Every time the moving averages catch up with price, they muscle price to the upside, okay. Price in this uptrend, price cannot breach below the dynamic area of support, okay. If it did breach below, I would consider this trend weakening down, and therefore I would probably cancel any possible trading opportunity on this chart, okay. So as you can see, no matter what currency pair you like to follow, no matter what time frame you like to base your trades on, all those 6 conditions are, when they apply, when they all fall in line, and the moving averages are well, lining out as I like them to see, okay, as I like them to be, as I like them to plot in my chart, with those 6 conditions falling in line, you are looking into solid trend, okay. The moving averages point you in the direction of high probability trades. In this case, clearly you want to be searching for long entries. Long entries are high probability trades, short entries are a bad idea, okay. When you see the moving averages, when you find this type of trading setups, okay, when the moving averages are plotting on your chart this way, fulfilling those 6 conditions, you don't want to trade against the moving averages. Don't trade against the market flow. The market is telling you, the moving averages are telling you that this market is buying the euro against the sterling pound. Therefore, you don't want to be short here, okay. You don't want to enter short here. You only want to be searching for long entries in the direction of the market flow, okay. Why would you want to fight the market flow if you can swim in the direction of the flow, okay. In fact, let me show you another chart where the moving averages are, well, basically not falling in order, not pointing the same direction, etc., etc. In this case, is the euro against the Japanese yen on the 1 hour time frame, okay. And as you can see, well, first of all, we have plenty of crossover, okay, moving average crossovers. Well, the moving averages are pointing, each of them is pointing in a different direction. They are certainly not in order. Price is not respecting the dynamic area of support and resistance at all. I mean, price is in fact breaching above and below, breaking the 100 moving average a number of times throughout the chart, etc., etc. Whenever you see this type of price action, basically what you usually have is a ranging market condition. Okay, in fact, if I draw 2 horizontal lines, we can see how price has been, well, bouncing up and down without any clear market direction, and therefore, you know, any type of trading decision you may take on this type of charts, it's going to be a low probability trade, because there is no the bulls and the bears are, well, let's say undecided as of where they want to push price, as of in which direction this chart is heading to, as of in which direction price is heading towards, and therefore you don't want to search for trading opportunities. I always say that if there is no trend, there is no trade. It's pointless to try to risk your money searching for trading opportunities in this type of market condition. Prices is chaotically bouncing up and down, okay, within two horizontal lines, and you can never know when it's going to breach above, when it's going to bounce off it, etc., etc. Okay. The best trading decision you could actually take when you see the moving averages crossing each other, not parallel to each other, not in order, etc., etc., is to not trade at all. That's to stay out of the market. That's the best trading decision you could take at this junction of the chart. Okay. Actually, just compare this chart I'm showing you right now, Euro against the JPY on the 1 hour time frame. Compare this chart with this one. For example, with the one I was showing you before, the first one I showed you at the beginning of this video, the American dollar against the Canadian dollar. This one clearly shows a market bias. Okay, the market is selling the American dollar against the Canadian dollar, and therefore you want to follow the market. You want to be searching for short interest in this market. The market bias is very clear. The moving averages are telling you exactly the direction as of where you should be trading, either long or short. In this case, clearly short. Whereas in this other case, okay, well, the market is basically telling you nothing. It's just telling you, stay out of this mess, okay? Do yourself and your trading account a favor and stay out of the market. All right, now, I've already talked about those three simple moving averages, and especially how those 6 conditions can help us determining the health of a trend, how solid is the trend, etc., etc. But now I want to show you how to realize in advance when the trend is about to get, to get in troubles. When it's perhaps, how to hear early warnings, early bells of warning that the trend may be coming to an end, or at least maybe slowing down, and we might want to be out of the market, to not consider trading that trend anymore. Okay, I'm going to show you another chart now. It's the Canadian dollar against the CHF on the 4 hours time frame. It's a pretty zoomed out chart because this trend has been in place for ages. It's a long trend. But I want to show you. I want you guys to focus on the right end of the chart. As you can see, well, all this time along, price has been bouncing very harmonically off the dynamic area of support. In this case, as we're in an uptrend, it has indeed holding price above. All the moving averages have been in order. The 30 above the 50, 50 above the 100, all of them parallel to each other. All of them, meaning that there's no crossover, all of them pointing the same direction, meaning up, etc., etc., etc. Price nowhere near the 100, etc., etc. So basically, what we are looking into is a very strong uptrend. Moreover, it's been in place for, like I say, a number of consecutive weeks. So it's certainly been quite a beautiful run up, okay, all the way from here, okay, where the moving averages fell in line, all the way, up to here. This has been a beautiful run up as per the moving averages. They've remained in order, parallel to each other, pointing the same direction, etc., etc. So it's been basically quite a long, beautiful, nice run up. Okay. Now, if we focus on the right end of the chart, I'm going to be scrolling very slowly. Like I say, towards the right, and you will see how price unfolds and how we may read price action in real time to get those early bells of early warning that the trend might be coming to a halt, okay, might be slowing down, and we may want to not take trades anymore in this trend, okay? Now, I'm going to be scrolling to the right, and bang, we have our first signal of warning right there, okay? Have a look at how price touches the 100, okay? Upon the last swing up, okay, which is this one I'm marking right now, we have a retracement, okay, right there. And then, actually, let me zoom in a little bit. Sorry about that, guys. Let's see. Keep scrolling forward. All right, there it is. That was the last run up I was talking about, the last swing up. Then we have the retracement. But have a look how the dynamic area of support doesn't hold the retracement anymore. Okay, do you look? Can you see that? How the 50 gets breached in momentum? Please pay attention. Take note of those two long red bars. Okay, with hardly no wicks at all. They are full-bodied bars, red bars, and against the trend all the way back to the 100. They indeed touch the 100. They break below the dynamic area of support, which had been working. Okay, remember when I said a quick breach below the 50 is all right. But this is not a quick breach. Okay, this is a full breakout, a momentum breakout more. Moreover, since we have two consecutive long red bars with no wicks all the way back to the 100. Remember what I was saying before, then when in an uptrending the pullback goes all the way back to the 100, it usually takes quite a deep bite into the trend. Well, have a look. We are almost back to the level where the swing started, okay? We gain, the bulls gain all this ground to the bears, but then they gave it up straight away to the bears, back to the bears in the pullback, and indeed the 100 moving average was touched, and as far as I'm concerned, as far as my system, my 3 simple moving average way of reading or gauging the trend, well, this is a clear signal of trend weakness. Okay, now if I keep scrolling, we will see how now we don't have the moving averages pointing in the same direction. Have a look at the 30. The 30 is pointing down, is it? Can you see that, guys? The 30 is pointing down. Now we don't have them all pointing up anymore, do we? They've been pointing all of them up all the way along, okay, throughout this part of the chart. However, at this point right there, we touch the 100. Now we have one of the 6 conditions is not applying anymore. Price has touched the 100, okay? Now another condition that is not applying anymore, price is not remaining above the 50, okay? In this uptrend, price is not spending most of the time on the right end of the 50 simple moving average. We've had, remember when I said 1-2 bars below is okay, but now we've had 1, 2, 3, 4, 5, 6, 7 bars. That's definitely price is not spending time at the right end of the 50 anymore. Now, moreover, another conditions that's out of place now. The 30 is not pointing in the same direction of the 50 and the 100. Another condition that's being wiped out, that's 3 out of 6, that within a minute, within few bars, from that point on, well, they've been basically wiped out of the list, okay? Now, let's keep scrolling. Bang! We have a crossover right there. You see that, guys? We have the 100 touched. The 30 is not pointing up anymore. Price is batting around under the 50 for way too long. Now we have a 30 moving average crossing over the 50. Okay, well, this trend, this is not a trend anymore. Okay, in fact, we can clearly see on the chart that we are trending no longer. We are now moving within a congestion area. We are moving sideways. I don't need no indicator. I don't need to draw no trend line. I only need to read price around my three simple moving averages. I just need to have a look at how the moving averages are plotting in my chart, and instantly I can tell you whether this trend is still in place or not. All the way up to here, okay, all the way up to this breakout of the 50. It was a beautiful trend, price nicely bouncing up. Now from this point on we are trending no more, okay? From this point on I want to search for no more entries on this trend, because as I just showed you, we are trending no longer. We are moving within a channel sideways. All right, now I don't know what's going to happen now. Well, I can keep on scrolling. Well, we keep on going sideways, as you can see. Okay, price continues to move sideways. We are not trending anymore. Remember what I said before: no trend, no trade. We had the trade all the way up to here. That was a beautiful trade, a beautiful trend. Long trades, long opportunities, long setups were high probability trades all the way up to here. From this point on, when we begin moving sideways, the moving averages are not showing fulfilling all the 6 conditions anymore. In fact, wow, we've thrown 1, 2, 3, 4 conditions out of the list. There are a number of conditions now that have been broken, and well, therefore we are certainly not considering any, or I personally would not be considering any more any long entry any longer. Okay, like I said, we are consolidating sideways, and I don't trade within ranges. I only trade within trends, okay, such as this time around, this earlier part of the chart. Okay, so now you don't need to plot that many indicators on your chart. Okay, you don't need to cluster your charts with a number of indicators, getting confused with different signals from all those different indicators, MACDs, stochastics, Bollinger Bands, etc., etc. That's just an overload of information, and you quite frankly don't need it. Okay, you just need 3 simple moving averages on your screen. You need to analyze how they are plotting on your chart, whether they are in order, whether those 6 conditions are applying. You need to read price around those moving averages, whether the dynamic area of support and resistance is holding, whether price is indeed spending most of the time at the right time of the 100, whether we get any crossover, etc., etc., whether we are ranging. That's very important. Are we trending or are we ranging? If we are ranging, we don't want trades. Those are low probability trades. We only want trades on the trending part of the chart. Okay, all the way here we want to be searching for trades. At this junction of the chart we want to be searching for trades no longer, because those are low probability trades. Excuse me. Okay, that's basically all, guys, for this first video. Now what I recommend you is to scroll back in your charts, search for it doesn't matter what time frame, it doesn't matter what currency cross you choose. Okay, search for times in your for those periods in your charts where those 6 conditions have been applying. Okay, draw those, plot those 3 simple moving averages. Scroll back in your chart, search for times when those 6 conditions have been applying, have been fulfilled, and you will see that you were looking into healthy trends where most of the trading signals were winners. Okay, I don't want to get into trading signals, entries, exits, etc., etc. in this video. I will leave them for future chapters, future videos. But for the time being, I recommend you to scroll back in your chart, experiment with those 3 simple moving averages, the 30, 50, and 100. Search for those 6 conditions to be fulfilled, and you will see by yourself with your own eyes how when those 6 conditions are indeed applying to the chart, you were looking into solid, high probability trends, strong trends, and that's precisely the type of price action you want to trade, okay? Alright folks, that's all for this video. I will be seeing you in the next video. Bye bye.